Hey, what's up, everybody? It's Mr. White here with some notes for you about monetary policy. Get out your notebook and follow along as we talk about the ways that the Federal Reserve, which is the central bank of the United States, manipulates the supply of money. So, we're going to talk about money first. Now, I think I told you guys at the beginning of this class, most people think economics is all about the study of money, but we know that's not the case. Economics is actually the study of choices and scarcity. As I promised, we wouldn't talk about money in this class until halfway through the course, and here we are now, we're halfway through the course. So now we're finally going to talk about money. Now, money just means any item that's generally accepted in payment for goods and services, right? So something we can use to buy stuff with. And in the United States, we have what's called a fiat money system. Now, fiat money does not mean money that's used to buy small Italian cars. The term fiat means by order or decree of the government. So when we say that we use fiat money, what we're saying is that our paper money only has value because the government says so. Now, another kind of money that has value just because of what it is, or what we would say is intrinsic value, is known as commodity money. So, for example, gold is a type of commodity money. Gold has value because it's gold. We don't need the government to tell us that gold is valuable. But when it comes to pieces of paper with dead politicians and presidents on it, the only thing that makes those pieces of paper worth anything is the fact that the government says so. As a matter of fact, if you look on any of our money, it says, this note is legal tender for all debts, public and private. That means you can use it to pay for stuff. Now, when we talk about money, you can identify money because money always has some basic functions. For one thing, money is a medium of exchange. Medium of exchange means that it's got to be accepted by people for buying and selling goods and services. Now, to be a good medium of exchange, money really needs to be portable. And what that means, obviously, is you can carry it around really easily. So using a giant stone as a type of money would not be very good for an option. Instead, we want something light, we want something easy to carry, something that we can carry a lot of it and it's not going to burden us too much. The next thing is it needs to be divisible. And what I mean by that is you can have large amounts or you can have small amounts of money. In other words, you shouldn't just have one denomination, you should have multiple denominations. And it needs to be uniform. That means that all the units of our money look the same. And every unit of money is worth the same as an equivalent unit. So every dollar has the same value as another dollar, right? So all those things make money a good medium of exchange. If money is those things, it really meets that definition as a good medium of exchange. Next up, money is a unit of account. What I mean by that is that it's useful in quoting prices. In other words, if we want to know how much something costs, we quote that in terms of dollars. Like, for example, a milkshake might cost $3. Okay? Now, we know that money can give value to more than just goods and services we buy. We can even use money to quantify production in our economy. Hopefully you remember that GDP, gross domestic product, is measured in, you guessed it, dollars, right? So once again, that's money serving as a unit of account. And for it to be a unit of account, it should be familiar, meaning everybody recognizes it. We said it needs to be divisible, meaning like you can have multiple different denominations, and it must be accepted everywhere as a medium of exchange. Money should also serve as a store of value. What I mean by a store of value is that something that allows you to defer your purchasing power from now until sometime in the future. So in other words, money should be durable, right? It should be something that can last a while so we can keep it for future use. That's the reason why our money is actually not made of regular paper. I'm sure you've probably noticed it doesn't feel like a normal piece of paper. Our money is mostly made out of cotton and linen. So I would say that the money in your pocket actually has more in common with your jeans or your t-shirt than it does with the piece of paper that you're taking notes on right now. And the other thing is money needs to be stable. It shouldn't just lose its purchasing power because it's disintegrating or something. So we wouldn't probably want to use like, I don't know, like lemons or oranges as money because money would that money would not be stable. Just think, a lemon or an orange is going to go bad after a couple days. So you can't store it for future use. So when we say that money is a store of value, and we mean that you can put that money in your piggy bank and you can leave it there for 5 years, and when you go to pull it out later, it's still going to be the same money, and it should have roughly the same value. Of course, we know money loses value because of inflation, but unfortunately, there's not much we can do to stop inflation from happening. When we talk about the money supply, what we mean is how much money is in circulation. So in other words, how many dollars are actually available for all of us to use. The last time I checked, there's around $3 trillion of U.S. currency in circulation around the world today. So that means that there are the equivalent of $3 trillion in bills and coins out there. Now, a lot of that circulates outside of the United States, meaning that there are a lot of countries around the world where people are actually holding on to U.S. dollars for various different reasons. Sometimes they're holding on to them to facilitate trade with the United States. Sometimes they're just holding on to them as an investment because the value of the dollar is quite high, and the dollar is a very stable currency. So you remember that means that we don't have a very high inflation rate on our dollar, and that makes the dollar very desirable to people in other countries, especially countries with a high inflation rate, like Venezuela. Currently, right now, people in Venezuela are dying for dollars. They just can't get enough dollars because their currency, the bolivar, is virtually worthless. Remember, they have something like 2,000% price inflation over the last year. So every single day, the bolivar loses value, whereas the dollar is still relatively valuable. Okay? Now, it's the Federal Reserve that keeps track of all of our money that's in circulation. So let's talk about this Federal Reserve. Okay? Now, when we talk about the money in circulation that's controlled by the Federal Reserve, there's two different measurements of money. There's what's called the M1 supply of money. The M1 supply means it's money that's in circulation or money that's very easily available to go into circulation. So like cash in your pocket or money in your checking account, which is known as a demand deposit. Those things are what we call liquid. Liquid means easily spendable or easily converted into spendable cash. Obviously, cash is already spendable because it's cash, and your checking account is easily convertible into spended cash. Basically, all you need to do is go to the bank, put your ATM card in the ATM, and bada bing, you got cash. Now, the M2 supply of money is the M1 supply plus other types of assets that are not easily turned into cash, like, for example, money in your savings account. Now, I know you're going to say, oh, but Mr. White, I can get money out of my savings account right now. Sure, you can, but there are usually a lot of restrictions on your savings account, meaning that you can't pull out all of your money at the same time. And if you do pull out all of your money at the same time, you're probably going to have to pay a bunch of fees. And so that would discourage you from pulling that money out. Other types of money that's in M2 would be things like money in your certificates of deposit or money market or mutual funds. Those kind of deposits are special kinds of bank accounts that earn extra interest, but they're not easy to access. For example, a certificate of deposit, you're essentially agreeing not to touch the money for a specified period of time, usually 6 months to a year. So M1 is all the money that we can use right now. M2 is M1 plus money that we can't spend right now. And so if you look at this sort of like little Venn diagram I've got going on here, you can see that M2 is the big blue circle, and contained within that big blue circle is the smaller green circle. The smaller green circle is our M1 supply of money, and the big blue circle is the M2 supply of money, which also includes M1. The good news is there won't be many questions about that on the test, so if I've confused the heck out of you right now, don't worry about it too much. Just, make sure you write this info down, and you may see like one question on the test about it, but I don't even think there's even one. So moving on. The Federal Reserve. Okay, so the people who keep track of the M1 and the M2 supply of money is the Federal Reserve. Now, this might sound kind of confusing, but even though it's called the Federal Reserve, it's actually not a part of the federal government. The Federal Reserve is an independent bank, and it serves as the Bank of the United States. So for the federal government, they have a bank account with the Federal Reserve. Not to mention commercial banks like Wells Fargo, Bank of America, Chase Bank, Capital One, they have an account with the Federal Reserve. But you or I, or even a business like Microsoft, they're not allowed to open accounts with the Federal Reserve because the Federal Reserve is the Bank of the United States and it's the bank of banks. So nobody besides the federal government or another bank can have an account with the Federal Reserve. Now, when we talk about the Federal Reserve, oftentimes we just refer to them as the Fed. And I know that when you guys hear the term Fed or the Feds, you're thinking about police. We're not talking about police, we're talking about the Bank of the United States. So from now on, whenever you hear me talk about the Fed, I'm not talking about cops, I'm talking about bankers. Now, the Federal Reserve is run by 7 generals, and I don't mean like military generals. They're actually called the Board of Governors, and a chairman. And so the 7 generals and the chairman make up the Board of Governors. They are all appointed by the President of the United States, and the generals serve a 14-year term, while the Fed chairman serves a 4-year term. The current Fed chairman is a guy named Jerome Powell, and he's a banker. He was a member of the Board of Governors before he became the Fed chairman. He was just one of those 7 generals. But he was appointed by President Trump at the beginning of this year to be the leader of the Fed. And so he is the head honcho when it comes to what we refer to as monetary policy. Now, the Federal Reserve System is divided into 12 different regions. And as a matter of fact, if you look right next to the map of the United States that's just to the right of the whiteboard, you'll see there's a couple little skinny posters about the Fed. And on those skinny little posters, I've got a map that shows where all the different regional Fed banks are located, as well as the corresponding number that goes with each Fed bank. The Fed Bank for Texas is located in Dallas, and Dallas is the head of the 11th region of the Fed. So if you look on your money and you see an uppercase letter K followed by a number 11, that means that that money was originally put into circulation by the Federal Reserve Bank of Dallas. As a matter of fact, on your way out of class, if you take a look at my big $100 bill rug that's on the floor, you'll see that just below the serial number to the left of Benjamin Franklin's head is a black K11. So that means that if that $100 bill was actually real, it would have been a $100 bill that was issued out by the 11th District of the Fed in Dallas. Now, let's talk about what the Fed does, which is called monetary policy. Monetary policy just means the actions that the Federal Reserve takes to influence the level of real GDP and the rate of inflation in our economy. As a matter of fact, this is similar to fiscal policy, which we just learned about. Remember that with fiscal policy, the government is trying to smooth out those fluctuations of our business cycle. Well, with monetary policy, the government is not involved, it's the Fed. But they're doing the same thing. The Fed is trying to smooth out those fluctuations in our business cycle. Now, the way that they can do that is by increasing or decreasing the money supply, and that has a big effect on things like interest rates. In case you're not familiar with that term interest rate, an interest rate means how much it costs to borrow money. So if it costs more to borrow money, then fewer people borrow money, and therefore fewer people spend money, which slows down the economy. If interest rates are low, then it's cheaper to borrow money, and so more people will borrow money, and if more people borrow money, they're going to spend it, and that causes the economy to speed up. So when it comes to the tools of the Fed, they have 3 basic things they can do to implement their monetary policy and either speed up or slow down the economy. The first tool is called the reserve requirement. That means the percentage of checking account deposits that banks have to set aside in reserve to cover withdrawals. So during the Great Depression, you might remember that there was a big run on the banks. The run on the banks was a disaster. It caused about 30% of all the banks in the United States to go out of business, and that made the Great Depression even worse than it would have been if the banks wouldn't have gone out of business. So after the Great Depression, the Federal Reserve decided that every bank must hold on to at least 10% of the money that's put into people's checking accounts. That way, if anybody ever wants to withdraw money from their checking account, the bank always has some cash on hand. Now, I know you're probably saying, but wait a minute, Mr. White, if they're only holding 10% of my money, what if I want to get out 100%? Well, you can still get out 100% of your money. As a matter of fact, that's why checking accounts are called demand deposits. You can get all of your money on demand. Now, the way that the bank makes that work is that you are not their only customer, right? The bank probably has millions of customers. And for every single one of those customers, the bank is holding on to 10% of their checking account. So unless you just have billions of dollars in the bank, it's very unlikely that the bank won't have enough money in reserve to give you every single dollar in your checking account. Okay? So the reserve requirement just means how much of your checking account the bank would have to hold on to. Since the reserve requirement is 10%, let's say if you put $100 in the bank, that means the bank has to hold on to $10 of your $100, but then they're free to loan out the other $90 to other customers who want a loan. The reason why they do that is because banks are not doing it out of the goodness of their heart. Banks are not a nonprofit business. The only way a bank can stay in business is if they earn a profit. And the only way that banks can earn a profit is by charging interest on loans. So that's why they do that. Now, the second tool of the Fed is called the discount rate. The discount rate means the interest rate that the Fed charges to financial institutions, aka banks, for short-term loans. So if a bank starts running low on their reserve requirement, let's say if they had a bunch of people come in because it's the holidays and they all pulled money out of their checking accounts, and now the bank doesn't have the full amount that they need to have in reserve. Well, whenever that happens, the bank will usually borrow money from another bank. But if other banks aren't willing to loan, then the only option that that bank would have is to borrow money from the Federal Reserve. Now, the interest rate that the Federal Reserve charges is low, and that's why it's called the discount rate, because you're getting a discount on the interest rate that you borrow from the Fed. Now, whenever the Fed wants to encourage more borrowing and more lending, what they do is they lower the discount rate. When the discount rate goes lower, it's cheaper to borrow money. And so therefore banks will borrow more. And if banks borrow more money, that means that you and I can borrow more money. And we're all going to get a lower interest rate. Lower interest rates encourage more borrowing. And if people borrow more, ceteris paribus, they're going to spend more. Now, if the Fed wants to slow down people's purchases, what they're going to do is raise the discount rate. When that discount rate goes up, it's more expensive to borrow money. And so therefore, people won't borrow as much. Now, the last tool of the Fed might be the most confusing. It's called open market operations. Open market operations means when the Federal Reserve buys or sells government bonds. A government bond or government security is like an IOU that's given to you, given to the government by you. So like down in the bottom corner here, you can see an example of a government bond. It looks like money, but it's not money. Basically, if you loan $200 to the government, they give you a bond that looks like this one down here, and that is like an IOU. So after a specified period of time, usually like 10 years, you can turn in that bond to the government and they'll give you back your $200 plus interest. Now, the Federal Reserve can buy these bonds from banks, or they can sell these bonds to banks. If the Fed wants to speed up the economy, they need to put more money in circulation. And so what they'll do is they'll buy bonds from banks. When they buy bonds, it makes the money supply bigger. And so that's what I would write in your notes. Buy equals big. If they buy bonds, the money supply increases. If the Fed wants to slow down the economy, they're going to take money out of circulation, and they can do that by selling bonds to the banks. When they sell bonds to the banks, it makes the money supply smaller. So I would say sell equals small. Okay, buy equals big, sell equals small. Now, this is one of the primary tools for fighting inflation or fighting unemployment during a recession. By putting more money into the economy through buying bonds, it makes it easier for everybody to get money. As a matter of fact, we call that an easy money policy because it's just easy to get cash when everybody has cash. If the Fed is worried about inflation and they want to slow the economy down, what they're going to do is they're going to sell those bonds. When they sell the bonds, they take cash away from the banks. And when the banks don't have any cash, then that means it's harder for you and I to get cash too. And so that's going to slow down people buying stuff, and therefore it's going to slow down the rate of inflation. So make sure you know, open market operations is when the Fed buys and sells bonds or government securities, right? Government securities and bonds means the same thing. If there's too much money out there, the Fed will sell bonds and make the money supply smaller. If there's not enough money out there, the Fed will buy bonds and they'll make the money supply bigger. So let's talk about a contractionary monetary policy or a tight money policy. This is what the Federal Reserve would do if our economy is in an expansion. So just like with fiscal policy, the name of the monetary policy we use is always the opposite of where we are in the business cycle. So if we're in an expansion of the business cycle, we're going to use a contractionary policy. So contractionary policy happens during the expansion or the peak of the business cycle to fight against inflation. We're trying to keep prices low. So to solve the problem of inflation, the Fed needs to reduce the money supply. When there's less money out there, it's harder for people to spend money, and that keeps inflation low. So this is how the Fed would implement a contractionary policy. When it comes to the reserve requirement, they're going to increase the reserve requirement. That means they're going to force the banks to hold on to more of the money that's in our checking accounts. If the Fed holds on to, if the banks hold on to more of the money in our checking accounts, then that means they can't loan out as much money to other customers. And so that decreases the money supply in circulation. They're also going to increase the discount rate. Remember, we said the discount rate means how much does it cost for banks to borrow from the Fed. If they make it more expensive to borrow money from the Fed, then the banks won't borrow as much, and they're going to raise the interest rates for all of us in the regular economy. And so what that would do is that would decrease the amount of money in circulation because there won't be as many loans going out if the interest rates are high. And then the last thing, open market operations. Remember, we said sell equals small. So the Federal Reserve will sell bonds to the banks, which causes the banks to have to give money to the Federal Reserve. The Federal Reserve will put that money in their vault, and now the money's out of circulation. So when the money goes out of circulation, then that means the money supply decreases. So you notice how all three of these things, increasing the reserve requirement, increasing the discount rate, and selling bonds, will all decrease the money supply, and hopefully that will decrease the rate of inflation. So now let's talk about expansionary or a loose money policy. Like if you say that somebody's loose with money, what we're saying is they spend it a lot. They make it easy to get money. So an expansionary monetary policy is going to happen during a contraction of the business cycle. When we're in a recession or a contraction, we need people to spend more money to get us back into an expansion again. And so that's why this is called expansionary policy. We're trying to get people to spend money again. So this would occur during the contraction or the trough phase of the business cycle. And it's all about fighting unemployment. I know it says fight recession. Just keep in mind that a recession is scary because of unemployment, okay? Now, to solve the problem of unemployment and recession, the Fed needs to increase the money supply. In other words, they need to put more money into people's hands so that they can buy stuff. When people buy stuff again, businesses start hiring people again, and that fixes the problem of unemployment. So here is how we would implement an expansionary monetary policy. First of all, the Fed is going to decrease the reserve requirement. When they decrease the reserve requirement, that means banks don't have to hold on to as much of our money. And so therefore, they're going to loan more money. That makes the money supply increase. When it comes to the discount rate, remember that's the interest rate that the Fed charges to banks. They're going to make that discount rate lower so that it's cheaper for banks to borrow money. If it's cheaper for the banks to borrow money, they're going to take more money, and they're also going to give us a cheaper interest rate so that all of us can borrow money more easily. Once again, that's going to put more money out into circulation. The last thing, open market operations, remember that's buying and selling government bonds. They need to buy bonds to make the money supply bigger. Basically what's going to happen is the Federal Reserve will take away those illiquid bonds and replace them with liquid cash. So once again, that's going to increase the money supply and allow banks to increase their lending to consumers. All of that is aimed at increasing consumption, and we know consumption is 70% of our GDP. So if you increase consumption, you're definitely going to increase GDP.